Welcome to today's case study titled Mule in a Suit: When Business Accounts Become Laundering Pipes. Published on December 1st, 2025, this case highlights a rising cybercrime trend where criminals are no longer using individual bank accounts for money laundering. Instead, they are targeting business accounts, especially small firms, proprietorships, and newly created entities. This shift is important for students interested in fintech careers, faculty teaching compliance or digital finance, and industry leaders building secure financial systems in India's fast digitizing economy. This case is important because it sits at the intersection of three fast-growing areas: digital payments, cybercrime, and regulatory compliance. As India becomes one of the world's largest digital payment economies, financial fraud is evolving. Understanding how criminals adapt and how the ecosystem must respond is essential for future professionals in banking, fintech, cybersecurity, and regulation. Business accounts are increasingly exploited for money laundering. Fraudsters target small businesses, using their accounts to mimic legitimate transactions. Newly opened, dormant, or low-activity accounts with sudden spikes are high risk. These accounts naturally handle larger transactions, providing ideal cover for illicit activities, complicating detection efforts in the digital payment landscape. The shift from retail to business mules involves targeting small businesses and proprietorships. Fraudsters exploit newly opened, dormant, or low-activity business accounts, which naturally handle larger transactions, making illicit fund movements harder to detect. This method effectively camouflages laundering activities within normal business flows, posing significant challenges for financial oversight. Fraudsters target small firms with fake loan offers or payment processing work, gaining access to bank credentials. They layer funds by moving scam money across multiple destinations, exiting cleanly as legitimate business payments. These accounts act as transit hubs, with some using bogus goods and services tax registrations as fronts for laundering operations. Business accounts are prime targets due to their high transaction limits and expected large inflows/outflows. Many small firms lack robust financial controls and anti-money laundering awareness, making them easy prey. Weak know your customer processes and limited monitoring further expose these accounts, offering criminals a perfect cover with genuine activity and low audit sophistication. Artificial intelligence and machine learning analyze transaction data and behavioral patterns, identifying anomalies like unusual spikes or geographic changes. These insights are shared with bank risk teams and law enforcement for deeper investigation. Regulatory technology and financial technology startups partner with banks, providing specialized tools to enhance monitoring and stay ahead of fraudsters. Enhanced Know Your Customer processes are crucial, with the Reserve Bank of India mandating stronger onboarding and periodic profile reviews for current accounts. Continuous risk scoring is essential for small business segments, while mandatory suspicious transaction reports must be filed with regulatory authorities. Non-compliance leads to severe penalties, reputational damage, and potential loss of correspondent banking relationships. Small businesses face frozen accounts, losing working capital and reputation, leading to cash flow crises. Banks and financial technology companies encounter rising compliance costs, necessitating investment in cybersecurity and analytics. Customers and society suffer from eroded trust in digital payments, with vulnerable citizens targeted by scams, causing ecosystem-wide reputation damage. Designing safer digital finance requires a design-first approach, integrating fraud prevention into product design from the start. Balance user experience with security by combining simplicity with subtle risk flags and necessary friction. Cross-functional teams, including product, data science, compliance, and legal, must collaborate to ensure robust and secure financial products. Design an onboarding journey for small businesses that balances ease and fraud control by integrating seamless Know Your Customer processes. Track early warning indicators like unusual transaction patterns, sudden account activity spikes, and mismatched business profiles. Banks should focus on educating businesses about mule risks, offering resources and workshops. Regulatory technology startups can offer real-time compliance solutions, enhancing banks' fraud detection capabilities. Fraudsters are increasingly targeting business accounts as money mules, exploiting small businesses as both targets and vectors. Banks and financial technology companies must employ analytics, artificial intelligence, and robust know-your-customer processes. A holistic anti-money laundering strategy integrates technology, regulation, process, and education. Students should design a business mule risk framework focusing on risk indicators, alert actions, communication plans, and effectiveness metrics.